Sometimes what you're reading in the press and what's happening on the ground don't align. February 2023 is a great example. Buyers agents across my network are reporting long queues at open houses. Mortgage brokers such as Chris are reporting that new buyers are submitting loan applications in large numbers. Sales agents are reporting that buyers seem to have decided that now is the bottom of the market and the time to strike. But then CoreLogic released their January data and headlines reported more price falls across the country. And today, the RBA are expected to increase interest rates again. In fact, we'll have a live reveal in the middle of this interview. So what's the deal? What information can we rely upon?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
We've invited Eliza Owen, one of our favourite guests. She's the head of Residential Research Australia at CoreLogic, and she's come along today to help us tease out what data matters and what signposts she sees for the year ahead. Eliza is particularly great at helping us and you make sense of changing market conditions, and we've gone from huge boom to bust in record time. Is this solely due to interest rates? We suspect not, and we're looking forward to Eliza's insights into what the contributing factors have been and what 2023 might hold for us. Thank you so much for coming, Eliza. It's so good to see you.
Thanks for having me back. Great to be here.
You're on form, Veronica. You smashed that intro first time. Huh?
No
Good
stumbles.
Effort. No stumbles. It was amazing. Eliza, always good to chat. I think that it's such an interesting way to start the interview around what's happening now versus what we're seeing in the news. And I think someone like yourself, you get both ends of it. You get the past transactions and a lot of data, CoreLogic. It's probably when it's yourselves really, and probably REA and Domain who have the best. But you also see a lot of the stuff that's coming in terms of new listings and, valuation reports and things like that. So, what do you think the danger is people, looking at what's happened in the past and then trying to then think, well, that must be what's happening today on the street. And then maybe they're like, well, there's no point buying now. Prices are still falling. Like, what's your sort of take on the dangers in looking at the past?
That's a great question. And I think something that we've been having discussions on recently is the importance of focusing on high frequency metrics. So for us, a lot of that has been looking at the rolling 28-day change in the daily home value index. I mean, really since August, the rate of decline across the national dwelling market has been easing. So your peak rate of decline or your cyclical low was back in August, a 1.6% fall. We're sitting at about a 1% fall in home values over January. And below that, the composition is changing. So price falls continue to ease pretty consistently across Sydney, Melbourne and Brisbane, which have probably driven the bulk of decline in the value of Australia's property market because they are relatively expensive markets. Now we're starting to see some of those resilient markets like Perth and Adelaide sort of easing into more of a decline now, a little bit more of acceleration. We've had queries from customers, looking at things like the change in median sale price, and that data tends to be lagged because we're trying to account for all of the sales taking time to come through. So really the imputed metrics like the home value index, as well as your high frequency metrics like auctions, for example, can be a really nice high frequency read on what's going on. And some of those actually point to, a potentially brighter picture over the past few months when it comes to value. The past couple of weeks, we've seen the capital city's clearance rate at about 62%. And that's much higher than where we left off last year, where the clearance rate was around 55%. Noting that, volumes are going to start ramping up. So that larger volume will be more of a test of market conditions as well.
Do you think volumes are going to sort of ramp up? Like, I think, when you look at high frequency metrics, do you consider like you know, no, those automated valuation model sort of things that the agents will print out when they go out to an open home. I don't know if they're all doing that still, if they have given up on that sometimes. But you know what I mean? Do you see that as another way of like new listings that are coming? And do you look at that a lot?
Oh, absolutely. So we track them on a weekly basis, but we probably go by a 4-week rolling count most often. So when I say volumes are ramping up, they have to seasonally.
Yeah.
People are, back in the market again. So we've started to see auction volumes climbing week on week. They are lower than where they were at the start of 2022. I'm just trying to think, even looking at new listings nationally, we've seen about 29,000 added over the past 4 weeks nationally for sale. That's probably about 24% below where we would usually see new listings this time of year. So comparing to a previous 5-year average. And that's one of the really interesting components of this downturn is that so far people have been empowered not to sell as values have fallen, which we think is something that's put a bit of a floor under price falls as well. CoreLogic kind of contributes to some of the more dazzling numbers that you see in the media when it comes to, record peak to trough declines of around 9% nationally. But this is off the back of a very large upswing in prices. And it's another one of those metrics that's just been completely rocked by COVID and the extremities that we've seen in the underlying cash rate.
The one thing that seems really obvious to me across a number of different sort of schools of thought and industries is that we sort of need to throw out a few rule books following COVID, because things that we previously expected to happen when certain things happened don't seem to happen. One example in my own sort of backyard is that when there's a downturn in the market, usually you could shoot a cannon through an open house. Nobody's interested in property. And yet, last year, and even in the depths of it, which is just before August, because we could see things start to lift in the very end of July. So it's interesting that nationally, August was the month because we certainly saw that in Sydney. But in the depths of the worst part of the market last year, there were still fairly good numbers of people inspecting open houses, and even turning up to auctions that weren't street theatre in the way that they certainly were in 2021. People still turning up. So there's this curiosity and interest in property, even though they weren't necessarily buying property. That's something I've never seen in over 20 years of property. So just one small example of human behaviour, how it's changed a bit. And, there's some economists, some sort of rogue economists are coming out, I guess, and talking about the way that we even measure the economy and the way that we use GDP and basically the way in which we judge whether or not we've got a functioning economy needs to change. And so then you've got the RBA, and obviously we've got inflation, and then that's resulting in interest rate rises, which really and truly only impact negatively a small portion of our society. And in fact, they impact positively on retirees and self-funded retirees as well. So do we have to throw the rule book out? I guess it's a very long-winded question here, but are you seeing that the metrics that have been commonly thought of as being rock steady, these are the property metrics that we all make judgments and forecasts based on, are we having to redefine these models? Or we recreate the models that we use to work out what the hell's going on?
I mean, I am still looking to a lot of the same metrics, but I am noticing a shift in relationships like you talked about. And I think there's a few things that were kind of unexpected through the pandemic when everyone was thinking the property market was going to crash. And then we saw this real institutional reaction, not just in monetary policy, but in the banks themselves offering mortgage repayment holidays. So I think that's a really interesting recent lesson as we move forward into the so-called fixed rate cliff and how risky that looked. And in terms, so that I think that's one important thing to keep in mind is that you never know what that institutional reaction is going to be, but we probably shouldn't underestimate the power of government, the banking sector to, I guess, protect housing. Yeah, intervene. And Yeah, what you were saying about the number of people through open homes, I mean, that's so interesting because I think even if you look at ABS lending data, which between April, just before rate hikes, and December, the monthly amount of lending coming out has declined about 25%. We've gone from this record high of about $33 billion lent in the month of Feb 22 to, somewhere closer around, 24 billion or whatever. But the number of secured mortgages has not declined as much as the value. So it's almost like you still have relatively tight supply. You still have people that want to buy homes, but it's as though it's just the interest rate shift that's limited the borrowing capacity and the amount that can be physically spent on these properties. And
that doesn't mean that people then turn around and buy a property and pay 25% less for the same property they might have been able to get a year earlier, and that's a very simplistic way. A lot of people sort of seem to think that there's this direct straight line between interest rate rises and price falls as if that's going to happen. It's like, no, that just flies in the face of actually reality. And people don't have to sell. They're not going to do that. They're not going to suddenly take a 25% bath.
Yeah, definitely. 100%. So the key is serviceability. And as we talked about, there's probably some institutional intervention that, could take place if we got into any real sort of trouble. As it is, labour markets are extremely tight, and the peak of unemployment was only forecast to be about 4.5%, which is still a percentage below the previous decade average for Australia's unemployment level. Wages are rising, and household savings within, the GDP data has shown an erosion since we've moved beyond lockdowns, and there's been that post-lockdown spending boom. But I think there's a few other kind of stopgaps in place that are there for people to keep up with their serviceability. I'm not going to lie, I have seen and heard a few anecdotes of people who are considering things like renting out a room, moving back in with their parents so they can rent their recent property purchase out to keep up with rate rises. But it is probably those recent buyers, first home buyers who are a little more overextended and really at the margins, I guess, who are going to face issues with serviceability.
Eliza, you go, sorry.
Oh, sorry. What you just said there is very telling, because instead of selling, they're looking at what else they can do to keep the property. And so, all these people sort of talk about, the mortgage cliff, we're going to get basically half the country's property is going to suddenly hit the market. It's like, really? Let's be real about what people do when they're faced with the option of having to sell out of the home that they've tried so hard to get. Let's face it, it's not quick to buy a property to get into the property ladder. And what are they going to do to keep that property? And there are a lot more options these days. With the gig economy, there's heaps more options for them.
Well, yeah, I mean, absolutely. You can see that in arrears rate around the banks. You can see that it's very, very low. It's like if there was all of a sudden there's going to be this big lot of properties coming on the market, you'd see the arrears rate really jumping up. Like I think it's under 1%, from memory. Like it's really low. Then you've got people maybe the mortgages are going out. That's assuming that they can't refinance. They can't extend their loan terms again. They can't release equity. They, it's as a buffer. Like there are lots of options that people, it's not, they might have money in the interest rates go, but they might have money already in an offset account to help them. If that extra payment's got $1,000 a month and they've got 50 grand there, well, they're not worried for another 4 years, are they? So I think you're right. I think the borrowing capacity thing is an interesting one. Like 1 in 4 borrowers were going to their limit. In some suburbs, it was, that's probably a bit high, but some suburbs, it probably maybe 50% of the market was stretching. So if you think about the upgrader market for families in capital cities last year, you had 2 people stretching, and maybe out of 4 buyers, maybe one was a bit more cashed up, a bit more conservative. But so they're the markets that really came back, 15, 20% fast because, half their buyers had huge cuts to their borrowing capacity and there was much less competition. But, that doesn't mean that every buyer was stretching. A lot of buyers, they can borrow 1.5 million. Doesn't mean they're going to go and spend 1.5 million. They're going to go and spend $1 million. And so we've got lots of clients who are still purchasing at the same price as they were last year. Yeah, their mortgage is going to be more expensive under higher rates, but they haven't had to reduce their purchase price, so they're getting a lot more for their money. Eliza, RBA is going to talk in 10 minutes about interest rates. I'm going to put you on a before and after here. What's your sort of take, though, on, because a lot's happened with the inflation journey. You can see with market pricing that the expectation of the RBA rate is in as high as it's not going to go as high as it was last year, right? That's quite well publicised. But, the inflation story around the world is also, what's your take on what the RBA think about what's happening in the world and the fears around wage inflation? Do they think that the genie's back in the bottle, or do you think that they ultimately think that the game hasn't been won yet and it's still going to take a fair bit of luck to sort of get it back in it?
My understanding is that there's a particularly aggressive action on inflation this time around, because in the 80s and 90s, when we had spiraling inflation, this led to a tightening in monetary policy, which led to double-digit rates of unemployment. So the idea is very much to contain inflation rapidly, and after today, it'll be the biggest successive rate hike we have since the RBA started targeting. So my view, I guess, and I think this has somewhat been echoed by the RBA, is that we probably are moving past the worst of inflation. The headline results coming out at 7.8% for 2022, which was, a fraction under their 8% peak forecast. And we're seeing it so much through the housing perspective as well. We're seeing higher interest rates dampening the number of approvals that can come through the construction pipeline.
Yep.
We're seeing some of the biggest cost pressures around steel and timber, consistently seeing lower and lower price increases. Even rental values, we've seen a slowdown in the pace of quarterly growth in rents through December, and that was reflected in CPI figures as well. The other notable thing about the inflation picture at the moment is that over the December quarter, some of that inflation pivoted from non-discretionary spending like food, fuel, and rents to more discretionary spending like travel. So in a way, that's kind of good as well, because it means households have a little bit more control over reining back their spending, whereas they don't have as much control over what they spend on groceries or fuel.
Interesting.
Yeah, we had around the travel. I think that a lot of consensus was like everyone's burnt out in COVID, didn't travel, finally got the ability to travel in 2022. And it was like, well, we're going to go and do this holiday, right? We're going to go and have this. But we know next year we're going to have to make cutbacks, and I think that's, and I think even like things like food inflation. I mean, Woolies came out, I think it was last week, and was saying like, we think that the worst of the food inflation, the transport costs and, all the challenges with food is start to come down. Is it sort of, is there any other sort of elements of the inflation problem where you think there could be concerns or, that it's going to keep it stubbornly high and, ultimately that's going to keep forcing, employees to ask for wage increases, because that's ultimately what they're trying to do here, is to stop that happening en masse, and then we get this spiraling effect.
Yeah, I think the upside risks for inflation are around China's move away from zero COVID and the return of travel to Australia, and that only makes prices go one way from that additional demand. And the other thing that we don't have so much control over, at least in the short term, is extreme weather events, bushfire season and further flooding events and things like that, which can really create ongoing capacity constraints to the production of food as well. So that's something that the RBA highlighted towards the end of last year, is that whether we like it or not, we're kind of in a new era for inflationary spikes. And that is partly because of extreme weather events. It's partly because of the transition to renewables, and partly because we've seen increased global conflict as well. So I guess there are definitely some risks to inflation that Australia doesn't have a whole lot of control over.
So it goes back to rewriting the book, though, doesn't it? And also back to this thing about, like Australians controlling our discretionary spending, because you can't, if your loaf of bread costs more and you still need a loaf of bread, you're going to still buy the loaf of bread, right? But then you don't have to buy the new television or the new lounge or go on the holiday. And yet we seem to be doing that. I know the retail figures were sort of a little, And this is the
Down
problem.
for
They get
December.
reported as
Yeah.
it's positive if they're up. It's also negative if they're up. So it's hard to sort of follow.
It's a strange time, isn't it?
It is a
It's like
strange time.
when is a contraction in GDP like good news?
A good thing.
Yeah.
One thing that I noticed, so I was listening to some interviews that you gave recently, and you were talking about the more expensive property markets and how they had actually suffered more of a decline than the more affordable end of the market. And that's sort of interesting too, because you would think, yes, of course, if somebody's borrowing, more than $5 million for a house, for argument's sake, obviously interest bill is going to go up ridiculously, compared to somebody who's borrowing maybe more than $500,000 for a house. So proportionately, you would expect, yes, that's going to be a market that is they've got to earn a hell of a lot more money to cover those additional interest payments. But at the same time, they're not as vulnerable necessarily because they're not like first home buyers where they're just getting to the market the first time. They're struggling with dealing with negative equity, et cetera, et cetera. So how can you explain, I guess, what has transpired and why that may have happened?
I guess the first piece would be that it's just a reliable cyclical pattern. So we've always kind of seen the top 25% of Australian home values, capital city home values, Sydney home values, whatever the market you're looking at, it just has more volatility. And we've seen that recently, even with that more positive trend of smaller rates of decline. The top 25% of capital city house values had this 6.4% loss in the September quarter. That's now contracted to a 4% loss in the 3 months to Jan. I've even seen at the suburb level, areas like Gordon, East Kalara, stabilizing in the past 3 months, and those are $3 million house markets. So that's, it just is. In terms of why, I don't think there's one definite explanation. We do know that wealthier households tend to take on higher debt to income ratios, so it could be increased sensitivity to fluctuations in interest rates. It could come down to things like the way that very wealthy home buyers are compensated, and that, if interest rates are rising and company performance is falling, then maybe that's less compensation that you can look forward to if more of your pay is tied to, performance structure and things like that. And so, I don't know that there is a clear explanation. It's just one of those trends that we've always kind of observed.
I remember early on, it's probably within our first 50 episodes, we interviewed Frank Gelber, who used to, he's well and truly retired now, but he was, very well known as a property economist, in the day. And I remember him insisting there were 12-year cycles for starters, which I thought was rather funny, which we definitely don't have 12-year cycles now. But he did say, and I do remember that sticking in my mind about that upper end of the market being the most volatile. It can have, 3-time growth, and then it can fall by 50% and then back up. And so it is a rather interesting. So that's one thing that we don't have to throw out the rule book for. Then we can actually say, well, that's performing as expected. We still don't really know why, but it is more volatile, always has been, and thus far always will be. You also mentioned that resilient markets such as Perth and Adelaide. And I'm curious, what is your take on why they've been resilient? And what do you mean by resilience? Because I know Perth has had a shocker decade, really, before the COVID boom.
That is a really good point. I guess in the context of maybe over a decade or so, Perth has not been such a resilient market. But I guess we talk about that in the context of Australia's largest rate hiking cycle. The shock that we've seen that put to the Sydney market, which is down about 14% peak to trough. Across the Perth market, values have fallen less than 1% from a recent peak. In Adelaide, values have fallen around 2% from a recent peak. And that's also what we talk about when we note the variation across markets. So I would put that to a relatively long period of subdued property market performance. But I guess in terms of migration data, we're also seeing more positive trends for Western Australia and South Australia more generally. A bit of a kickoff in virtuous cycles around employment growth as well increased aggregate demand, which then attracts more people to the state. And it could also be the pursuit of home ownership and the relatively affordable price points, where your median dwelling value across Perth is about $560,000, $650,000 for Adelaide, compared to, say, $999,000 for median city dwellings.
Yeah. And
Do you
on
think
that
part of
too,
it, sorry, you go.
well, you talk about the affordability for people buying a home to live in, but there's also this push for affordability with in a lot of investor circles. So they rightly or wrongly, and in fact, I don't think you should be chasing affordability when it comes to investment, because it's not really a metric that actually pays dividends necessarily. But there's been a lot of talk about, a lot of attention and interest amongst investors in buying in Perth and Adelaide, probably precisely for that reason, the affordability reason. Are you able to pull out that data and work out who is buying there and whether or not investors are helping to prop up those cities?
I mean, I think that is probably a part of it. And certainly we've seen a general trend of higher gross rent yields across some of those more affordable capital cities as well. For as much as the property prices have had a large boom, throughout the past few years, Perth has seen some of the biggest annual increases in rents as well. So that could definitely be a part of it. I just did a little refresh of the RBA web page. If you guys want to, 25 basis points.
Is that what it is?
25. So we're
There
up to
you go.
3.35. Little live react for
Live
everyone.
react
Are
by
we
the team.
surprised? Anyone
Yeah.
surprised?
No.
Look, I think it doesn't really matter where it stops. It's going to stop at some point, right?
Yeah.
It's not going to stop at 6%, whether it stops at 3.35 or 3.6 or 3.85. It's the heavy lifting to both perception and people are already thinking that, right? So it's not till we go past what people are thinking. And so at the moment, if they didn't increase, you'd be surprised for the positive, right? So at the moment, everyone's just saying, well, that's what we're expecting anyway. So that's not going to change the market. So
Well, that's a bit of a fizzer for our little reveal in the middle of the podcast.
probably I would make a good Sky News presenter talking it up for 6 hours and getting lots of guests on.
Eliza would have been really terrible, I have to say, on the property show that I used to be a co-host of, because we used to have to wait to actually reveal anything, and I didn't get a chance to do a drum roll. But it was not that exciting. Anyway, so let's kick on with the interview.
Yeah. The interesting about the price declines, it's one person in particular is getting a lot of attention. We'd love to have him on the podcast around the price declines, and he's. And fairness, he's picked it all the way up and the down, and I won't say his name because it just feels like it. But
I think I know who you're talking about.
Yeah,
right?
and he ignores us and he won't come on. So.
And I've asked him 100 times on LinkedIn, and he just won't do it. But it's I don't know why not. Like,
Why?
why it'd be a good chat. But he even shut me down because he said, look, what's a fall's a fall, right? Like, I don't need to add context to this. Like, these are falls, right? But, in stock markets and things like that, maybe it's you might want to talk about this because people are sort of trading in and out and people got the ability to come in and out. Property markets definitely work a lot different to that. And, falls are really a lot of paper money, right? Like it's paper wealth, right? What your property price is worth is really only a tangible thing that matters if you're really going to use that equity to do something or you're selling and so what's happening at a number level doesn't really matter. And it does, a lot of context needs to be brought that, what happened last year in 2021 and in those markets you spoke about, they're the fastest growing markets. I mean, Perth might be resilient, but they didn't grow anywhere near as much as Brisbane and Sydney and Melbourne. And I think that's the key thing here is expanding it out to a multiple year thing. And I think that's often lost in this because everyone's looking at this last 12 months figures and saying, okay, prices are down. Okay, well, over 3 years, where are they? What's happening in the last month? Are prices slowing down? And those are the things that matter more broadly than annualized figures in the property market, if that makes sense.
Especially when it comes to an asset that's held for a relatively long time.
It should be.
Yeah.
Literally, someone, Carlos Cacho, who we've interviewed on the podcast, he just emailed us this morning to say, because we've been storing up examples of properties that had sold and then on-sold in the last short period of time, and he gave us an example of a property in Bronte that sold $4.75 million in October 22, and then just sold in February 2023 for, drumroll, 4.75 million. So despite the fact that official figures are saying that city dwelling prices and city housing prices are falling, that particular property sold for exactly the same price. So it bucks the trend. And that's only one example, of course, but
or
I'm
it
adding
could
that.
have moved up and down in that period as well.
Oh, wow,
was
it could have.
Just a
Yeah.
thought. What was the time period again?
Only 5 months. And so,
Yeah.
and you're only like, it's a very short time frame, but
Yeah.
it also shows that the seller would have known, the buyer would have known that it sold for 475,
Yeah.
right?
Yes.
So they've
There's
got
an
the
anchoring
mentality, I'm not going
bias.
to pay more, but to be willing to pay the same is different. Like, because
Yes.
they're also like, they're willing to say, well, I'm willing to match it. I think the market hasn't fallen massively down since then. And, one transaction is really hard. You never really know the circumstances. You know this, Veronica, right?
Yeah.
When you look at a sale at a price, you don't know whether that was a desperate vendor, if it was really hot at auction, 8 people went hammer and tong on it, if it was connected to the family, a better deal. Like, there's just so much things you don't know with sales and purchases, unless you're almost like a part of it or you're at the auction. You just don't know those things. And so it's hard to read too much into individual sales. I feel you got to have a lot to know. Yeah.
That 100% true. But it's just funny because, Eliza says, property is a long-term, long-hold asset.
Oh, right.
It should be a long-hold asset,
Yeah.
And despite the fact they got their money back in terms of nominal price, they certainly didn't get their money back in terms of the costs associated with it. But unfortunately, people don't always behave like it's a long-term asset because they're knee-jerking all over the shop and panicking when they read these headlines about price falls. And so it flies in the face, even though, yes, property is and should be a long-term asset, we often, our human frailties lend us to be very knee-jerky and very panicky around a lot of this data that we see, being reflected in headlines. So I find that fascinating. But also one of the things that I find fascinating is that there is a difference in lag time. And you mentioned it earlier, Eliza, about the hedonic, your sort of daily price and the median. And so the median relies on what has sold and settled, I'm guessing, in terms of what CoreLogic use. And the hedonic is obviously your measure for like a daily price index. What's the difference between the two? Can you sort of tease that out for us so we get a better understanding of this?
I'm on a personal mission to help more people make better property decisions. And you can find out all about what I'm working on at veronicamorgan.com.au. And there you'll find resources for first home buyers, details about my buyer's agent mentoring program, access to suburb help for investors, or if you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers.
If you're thinking about buying your first home, upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out via our website, wealthful.com.au.
Don't forget that you can download our free full or forecaster report. Which experts can you trust to get it right? theelephantintheroom.com.au.
Yeah. So especially when you're looking at something as simple as a median sale price, you're looking at a period where a bunch of properties sold. Say if you're looking year on year at the change in the median sale price, if you look at a 12-month period, you take the middle sale and then 12 months later, you do the same. All you're really comparing is 2 sales.
Yes.
So that, if something is happening in that market, like we're seeing a recovery at the high end, for example, and higher value properties start transacting as opposed to lower value properties.
Yeah.
That's why some data providers would use a stratified median sale price, for example, where they break up the market into different stratas, look at the change in the median sale price within those, and then average the sort of difference there. The hedonic home value index is an imputed measure, which means it's an estimate of property values. And instead of just comparing 2 transactions over time, we're trying to compute a valuation for as many properties in the market as we can, whether they're selling or not. And in valuing all of that housing stock, we're accounting for compositional bias. We're accounting for the fact that different types and value segments of property could be selling at any one time. We're using recent sales and listings information to feed into that valuation algorithm, but we're also using the individual attributes of the property. And we use machine learning to test our models and make sure that we're using the best variables in terms of property price predictors, which tend to be things like number of bedrooms, bathrooms.
Yeah.
And then in valuing every day, putting a value to the entire market and then tracking that over time, like you would have a stock market index. That's essentially what we've tried to replicate with the housing market. And I think the fact that CoreLogic produces a daily index tells you how obsessed we are with property in this country. But that's, it's a very sophisticated measure. It's got a lot of brilliant minds behind it, but it can be really hard to communicate to the general public. So we still get, comments every now and again on our reports, like median prices suck, and it's like, well, that's okay. We're not using median prices, but it can be hard to communicate that. But yeah, it's definitely our preferred measure.
I'm glad. Thank you for explaining that, because it is something that we're very aware of here.
Yeah.
And it's something that, through our many interviews with Kent Lardner as well, if you know Kent, he's been a great teacher, certainly to me, and I'm sure, Chris, you probably agree. We've learned so much about property data from our interviews with Kent. We learn a lot from you as well, obviously. And it is important. And I find myself sometimes, for a want of a better word, I use the word median price when I actually mean your hedonic index as well. So, but I think it is important that people do understand there is a difference. And also that the weaknesses or the flaws with relying on medians, because of course that compositional bias is really obvious. And it's one of those things I rant about, top 10 lists, because there's certain suburbs that seem to always be in the top 10 lists for the obviously either the biggest increases or the biggest falls, and that's because they're usually quite small, so they don't have a statistical significant number of transactions, and then there's quite a lot of diversity in terms of the type of property that would sell, and they might have workers' cottages at one end and waterfronts at the other, and if there's any skew in either direction, it can really stuff things up. So thank you for sharing that. I do appreciate it. So with that lag time, though, when the medians do get produced and released, because then they are talked to as well, is it then that we say, oh yes, what we saw in the hedonic has played out? Has there ever been a difference between the two?
They track. They correlate pretty well. And in fact, one of the ways we test the accuracy of the index, or not the accuracy, but I guess one of the ways that we validate the index when we're reporting on small regions as well, is just to make sure that things like the median valuation over time, the median sale price is pretty much in line with that. So there can be a bit of a difference at times, depending on what kind of stock is selling at the market, but generally they're all pretty well correlated. The benefit of using the home value index is that it's the most timely because it's estimates.
Yep.
So whereas the median sales price, for example, we want to make sure we've got as many observations as possible. So to collect all that sales data, it's taking a few weeks to sort of ingest that all in. We do get a lot of recent sales information that's collected very quickly across the business. But of course, if you want as many observations as possible, you've got to lag that data a bit.
So is that on a suburb level with the hedonic index, or are you just doing it at a national level?
We produce it down to the suburb level.
Yeah.
We will only report it where we think we have enough valuations and the index itself is not too volatile. So we have minimum reporting standards for the suburb level.
Yeah.
But that's only the month-end index. The daily index is only produced at a very high level, national, combined capital cities, things like that. Yeah.
But in time, it'd be good to be able to almost, I'm sure CoreLogic are working on it, is a suburb monthly, everyone can get access to every suburb. Is that sort of, you're not there yet though, are you?
We do have a free online resource called the Mapping the Market Report. So if you Google CoreLogic Mapping the Market, that's where we have mapped the 3-month and 12-month change in the home value index at a suburb level.
Yeah.
We used to do it quarterly. We've just started updating it every month.
Yeah, okay.
And that's where, if you go and look at that map of Sydney, you can see the areas that are starting to bounce back based on the 3-month growth rate. Really interesting. Unfortunately, it's not available as a time series. It's just a snapshot of of the latest 3 months of data.
So 2023 is a big year. What's Eliza working on? Like, what are your...
Oh, sorry, before you ask that question, because that will take us in different directions, just a very quick one, because days on market, they're quite a key metric when it comes to, you know, what's happening and what direction a particular market might be moving in. Is that sort of built into that mapping model?
No. So that is a really good point. We certainly can visualize it. It's just not something that we've set up automatically. We also have the free monthly chart pack, which is available via our website, and we report on days on market there, but again, at a pretty high level.
Yeah.
Suburb level we can do, but again, we'd want a minimum observation of resales.
Yeah, got it. Back to 2023.
So yeah,
Just
2023.
wants to know what you're
what are you
you're
working on? I mean, I've always got, you know, we've got our little life plans, our goals. I'm sure as a property person, you sort of think in data, you'd be like, oh, this year I really want to get stuck into this. Like,
yes.
What are some of the key things that are not really told out in the marketplace? I'm sure there's some little exciting, if you're allowed to share or want to share, that'd be awesome.
So I don't know about you guys, but I feel like beyond lockdowns, 2023 just feels so full of promise. And I wrote a bunch of resolutions and I haven't kept them all, but I've signed up to do, you know, a bit of learning and development this year to extend my expertise in the data space. In terms of topics, we'll be really scrutinizing this fixed rate cliff and how risky it is and what kind of impact it could have on the market over the course of the year. I'm very keenly interested in really data-driven insights around policy as well. We're starting to get a lot of, I don't know why it's coming back, but the millennial versus boomer debate, you know, we've seen the introduction of the first home buyer choice in New South Wales. We're getting a broader national political discourse around relying on private partners where the federal government is a little more fiscally constrained in what they can do in housing. So really better understanding, I guess, international examples of how different policies can affect housing markets and things like that. That's sort of where I'm thinking at the moment, but it's a big year ahead. Anything can happen. So we'll have to get ready to pivot, I'm sure, at some point as well.
I think that's a really good idea. I mean, the mortgage cliff and things like that, that's going to be like the interest-only cliff a couple of years ago. Like, you know, bank pricing's ridiculous at the moment. You know, people are getting ahead of it. You know, I don't think it's going to be a storm in the teacup. Banks are really proactive in this space. I think, you're definitely going to see people who maybe bought in 2021 with big mortgages and if incomes have been cut, they're going to have problems. But we spoke about they'll do everything they can. So I think that won't be that exciting. But if it were me, I think the exciting thing is what you're talking about, the housing affordability debate is not going anywhere, right? And plus the social impact debate, why we talk about it a lot. And the interesting thing is other countries around the world are having these same problems, and everyone's trying to solve this as a debate. And there's a lot of wealth in the world in retirement funds, in global, you know, government funds, the Future Fund of Australia, etc. So I think that's that interlinked between housing and global wealth. And what's working around the world, I think that'd be super interesting to keep dragging insights to Australia because, you know, that's what build to rent is. That build to rent's a new thing in Australia, but it's been going on for decades overseas, you know, social housing, you know, and etc. So is there any countries in particular that sort of you gravitate towards? We've spoken about Singapore on here where they give houses or properties to at low prices to first home buyers. You know, is there any other countries that you think are doing things well around the world that we need to take some insights from?
So Germany comes to mind as a really established institutional investment in that rental space and the kind of build to rent that you're talking about. But certainly I think Singapore is a great example in terms of shared equity and those kinds of government support schemes. I think the important thing to keep in mind for build to rent is that it's not necessarily been, I mean, I was sort of talking about this the other day, where you only have to look at something like superannuation to see that when we take big corporate action in aspects of Australian life that are so important, whether it's our pensions and future incomes and housing, you get a lot of variation in service, right? So build to rent is not going to be some miracle answer for amazing service for tenants or affordable housing or even secure tenancy. And I think we need to be, while I think it's good to have some new forms of housing introduced, I mean, we've got to be so skeptical and critical and hold that to a really high standard as well, and not just give tax breaks to corporations so that they can, build something that doesn't create secure and sustainable housing.
It's because it'd be like a bit of a convenient buck passing for the government, who have, all of our governments really have dropped the ball a bit when it comes to providing affordable housing. And so it's like, oh, yay, a whole new sector. Yeah, we can give them some tax breaks. Let them go for it. There's, I think it was Lend-Lease, was it, that came out today announcing that their recommendation is 30% of all new developments should have an affordable component. That's a very interesting announcement from a public listed company and obviously a big player in that development space. So is it going to go in the way that corporations have gone in the climate debate, that really government's not leading this, it's going to be organisations and they're potentially driven by their shareholders that are saying, right, we need to step up and do something here. It's quite an interesting space. I'll be fascinating to see, I guess, what comes of that and what you can make of that it's just not just this year, but this is really seems to be when these things are starting to take shape.
And also our transition, sorry to interrupt, but the transition to more institutional renting as well, and what that does for our future in terms of, because in a way, if your super fund is in the build to rent space, then technically you are raising wealth through housing.
Yes.
But if it also crowds out opportunity for owner occupation, and it does become much more normalized to rent in Australia than own, then it's like, how do we ensure that wealth at retirement? How do we overcome the fact that if you're renting as a retiree, you're much more likely to have housing stress and be in poverty? And, how do you address those things as well?
But would that be the same if we had better, availability of housing, in the future when those people become retirees? I guess you look at, New York is meant to be the poster child for affordable housing. I'm not sure how successful that is in that context. But I think that, once again, that takes a rewriting of the rule book. Australians have to reevaluate our attitudes towards home ownership and also, the wealth effect of that. But I think we are on the cusp of change on so many levels. So it is very exciting times, and hopefully you've got some personal resolutions or personal exciting things that you're looking forward to as well, not just all these lovely data projects.
So first home buyer choice, what's your thoughts on that? So you mentioned there, things that this year when you do a bit of a brain dump, you was coming all these things you were thinking about this year, the Sydney, and no, this isn't just about Sydney, this podcast, but New South Wales is a big state, right? This is a big policy. And, the election is, 6 weeks away or something, right? Labor $1.10 to win the election. So, it's highly likely they're going to win. The bookies have got Brexit wrong, Trump wrong, multiple other things wrong in recent years in politics. So you can't rely on it. But, and they've said they're going to cancel the policy, basically unwind it, how do you have it to $1 million? What's your thoughts on what is being proposed and what, Labor is saying? And do you think it's likely that, if Labor do win, they're going to cancel it, then they're going to do their policy? Or do you think there's going to be backlash? Or what's your thoughts on that space? Has anyone consulted you around all that? Or
Well, I guess Labor's proposal was just to increase the exemptions and concessionary discounts. I mean, from a fiscal position, I don't think it's sensible. I think it's going to cost state governments more money that they could be putting into social and affordable housing rather than helping first home buyers get into the market who are probably going to be in a pretty good position to get in anyway. It'll just take them longer, right? So I think we really need to triage government spending around housing at the moment, because nationally in the year to June 2021, there were 114,000 people who sought specialist homelessness services that were turned away.
Wow.
Like, we are in a crisis that has stemmed from a lot of stress in the rental market. And I'm sure you've had lots of discussions about some of the factors that have driven there. But I don't think it's very sensible. And then on the other side, you have this, what I get the impression was more of a broad stamp duty reform that Perrottet was trying to introduce that maybe has been watered down, scaled back quite a bit to a point where theoretically it wouldn't be very effective. Because the benefit of abolishing stamp duty and replacing it with a broad-based land tax is not that the first home buyer gets an easier entrance into their first home. That's part of it. But the main efficiencies are delivered through incentivizing people with more land than they need and more space than they need to downsize. So that's not a first home buyer. That's an empty nester. And yet this first home buyer choice is only targeting first home buyers.
I know, and not only that, but it's subsequent sales of the property. So today's first home buyer might decide to opt for land tax, and then if they sell that property and the next person is not a first home buyer, then it goes back in the stamp duty system.
Exactly.
So they're not even making any headway on this stated objective.
Yeah, and that has implications potentially for the initial purchase. Like, is the first home buyer overextending themselves to take advantage of that property tax option? Whereas ideally, if you took away those large upfront taxes on every property purchase throughout the course of your life, maybe the first home buyer starts with a smaller, more affordable property, knowing that they can upsize without. I mean, I say all this, these are the mainstream economic arguments for abolishing stamp duty, implementing the broad-based land tax. And I think when you look at it from a data perspective and the fact that the ACT has been phasing out stamp duty since 2012, and yet it's the second least affordable housing market by median value. So not necessarily something that brings house prices down, but potentially something that increases the efficiency of housing stock that we have.
And the argument there is meant to increase supply, right? So if there's takes away that impediment to transact. So if you have more supply, supposedly you're going to have a downward pressure on prices, but that obviously hasn't happened either.
Well, and it's one thing to say everyone in Castle Hill needs to downsize to a townhouse or apartment or something, but then there needs to be that higher density stock. Which there is, obviously. That's been established.
Maybe there.
I don't know why I pulled out that example, but you need the stock to downsize into as well. And what you find is that a lot of older Australians don't want to move away from their community to do that. Might not even want to downsize. I think getting rid of the stamp duty on a more broad basis, replacing it. You must replace to get the revenue with the broad-based land tax. Seems like it would be a step in the right direction.
Yeah, I think the whole idea when I first started really getting into property years ago, I was sort of like, oh, well, surely all these people are going to sell from the downsizers, the baby boomers, and and it's going to create this, as the wave comes, it's going to create all this stock, and people aren't going to be able to afford to buy these houses and things like that. But it just doesn't work like that, right? It's people living longer than they expect. If one party, even if both my nana passed away late last year, right? So she was 90, but my pa died 7 years ago. So she lived in the house by herself, for 7 years, right? So, technically she should have downsized, but there's so much emotional attachment. And it's not exciting to go to aged care and a lot of the government support you with living in the home for longer. So, if there was an amazing option for there as well, this is a great care option for you, you're going to be much happier and safer. And then that would free up a lot of housing, to pass down generations. But even that doesn't exist.
That's a good point. There's a lot of vulnerability in our aged care system and some horrible reports of treatment of older Australians. So I guess when you're looking at the housing market transition from a more holistic perspective, that's a pillar that you really need to address as well.
Yes, it's interesting that, the theory of what might happen when they put in place these policy changes and what really does happen isn't necessarily aligned. But also, what you're sort of talking about there is it's great in theory, once again, to free up these houses that have been lived in for many, many years of people. They can then downsize with lovely, lovely options going into aged care if all of our different arms of government actually spoke to each other. And we've got the same problem, which is probably the topic for a whole other interview around the increase in population in terms of, immigration. And where are those people going to live when we've got our worst rental crisis ever? Is it our worst one ever, or am I being hyperbolic? So there's all this stuff going on. So I think 2023 is going to be a very interesting year. I think we definitely want to get you back, Eliza. And we do love talking to you. And then every time we do meet with you, we think, oh my God, it's been too long. So we'll have to make sure that we invite you back a lot quicker this time around. When's the next Fool or Forecaster report out? Oh, so no, that's us. We do that.
That's you.
Pain and gain. The pain and gain one.
Yep. So we're looking at March for a release on the December data. So it's a bit lagged. Again, we're looking at resale observations that have actually happened, but I'm sure we can expect a bit of an erosion in the rate of profit-making sales.
That'd actually be a good one to look at, because 2022 is a year of decline, and it makes sense for people to cut and run when interest rates are going up, right? And so underperforming properties, right? They bought an apartment for $450, it's still worth $400. Interest rates are going to go from 3% or 2.5% to 6%. I'm going to lose even more money on this place. I'm just going to take my money and run. And my interest rate and my home loan's going up. There was that whole consensus that a lot of people would sell their investment properties versus their homes, which makes sense, right? Like if that's going to give
rents are going up.
Rents are going up, but interest rates have got up 3 times. So I think it's going to be interesting to see how many investors actually, because a lot of that would be in investors markets where you're losing a lot, not so much owner occupiers. Yeah. You can see that their percentages are much higher than the investor market. So let's have a chat in a few months regarding that. And you haven't got a recent property, Dumbo, you can share with us, Eliza, something that you've heard recently, just a nice little story to finish us off?
I have.
Yes.
Oh, there we go.
Mine.
Yours. Do tell.
It's my very own.
Wow.
Go on.
It all started. So my partner and I have exchanged on a property, which is very exciting. First time.
Congratulations.
Thank you so much.
You need a broker?
I said, did you need a buyer's agent? Well.
I think, and I think this is where a lot of the hubris and Dumbo comes into it. Is I thought I had the research and the know-how, but we're always learning. And one thing that I did not understand, which I feel like is quite a basic rule, law, which I should have understood, is that a new owner cannot break a fixed lease for tenants in New South Wales. So while I thought I was buying an owner-occupied home, there are tenants in there for a while. So we've sort of worked it out for I think that it's worked out the best for each of the parties involved. But just know that just because you've bought a property, it doesn't necessarily mean you can just move in at settlement if there is a fixed lease.
Did anyone tell you about it?
Well, would have been in the contract.
Yes. The agent was transparent about the fact that there were tenants in there and that the lease would end after we exchanged. I just didn't realize what that
you didn't join the dots.
The conveyancer didn't say part of their, conditions is that there's a lease.
I'm not sure how much detail I should go into. But to protect everyone involved. But I didn't think about this before I
it's interesting.
brought up my personal property, Dumbo. But
no, but it's interesting. It's interesting though, like, because it's, from a selling point of view, you'd really want to get the tenant out, right? Obviously they sold it with a tenant, so was it quite neat and tidy when you were looking at it? And
beautiful.
Yeah, so
they've treated it
love
very
the
well.
place, so they don't want to leave it as well. So you probably can't give them a moving bonus and say, hey, here's $3,000, if you want to leave in 6 weeks. They've probably got their stake in the ground, like they've made it their home, and they don't want to leave. So that's probably one of the other challenges.
I feel pretty conflicted about it, to be honest, because it is such a tough rental market out there. And this is one of those scenarios where, like, it's probably going to be tough for them. And we've given them plenty of notice, and we could even recommend the rental that we're coming from, I guess, as we transition to home ownership. But yeah, definitely.
It'd be nice if the agent, who sold it, should have a property management division and try to link two things up. But the sales has already been done, the commission's done, so let's go on to the next one. But no, I'm being a bit,
Just one thing I will add, and maybe you have already gone down this path, but have a chat to an accountant, because obviously there's capital gains implications when you buy a property with a lease in place, with a tenant in place. But there is a period of time, there's a grace period. If you can't settle and you can't move in because of a lease. So I'm not an accountant, so I cannot advise you on that. But what I would suggest you do is go and have a chat to an accountant to make sure that you don't inadvertently in the future, when you go to upgrade, find that you've got this tax bill that you didn't know you had. So,
well, that's great advice. And that's, I'm learning every day.
Yeah. I think it is really good advice, actually, because I think I think you should be right if it's the current lease. But what you could do is sign another lease for 2 months because you think, it's in December or it's November, just live them a couple more months because it suits me.
Yeah, you could shoot yourself in the foot.
Potentially, you could now no longer be eligible for something called the 6-year rule because you were trying to do the right thing. So you moved into it 2 months later, but it was actually technically a new lease, and then maybe that could rule you out. So I think that's wise thoughts there, Veronica, to really just be careful with that.
Well, that's why on Home Buyer Academy, Megan and I were like, we're old enough to be your mum. That's how we give our first home buyer advice. Just like your mum. Hopefully I'm not old enough to be your mum, Eliza.
I doubt that very much.
Another great chat.
Yeah, and it was just interesting when I relayed my situation. I was surprised by how many people said, I didn't know that either. So there you go.
Oh, we could do a whole episode on your first home buyer guide about exactly that. There you go. Food for thought. Thank you so much.
Congratulations either way on
Thanks,
purchasing.
Guys. Thank you.
And we'll chat again in a few months.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.